Hi, welcome to the Rage Money YouTube channel. I'm your host, William Zhang. Today we're going to talk about the upcoming inflationary recessions. What are some of the key points that we should be looking at, and what are some of the instruments that we could be trading in order to protect ourselves and obtain our financial futures? So now we have to go over what is inflation and what are some of the benefits of inflations in the US economy. Inflation in basic terms is basically money in the future is worth less than the money today. And that is good for the US economy because US economy is a consumer economy where people have to spend in order for the economy to grow. And a lot of times we borrow against our future earnings in order to spend today with things like cars or houses and sometimes vacations or clothing or some other things that might not generate value, but that's for another story. So the United States government, they often issue debt in order to fund social programs, things like Obamacare, things like Medicare, Medicaid, and Social Security. A lot of those things, for example, the coronavirus relief bill, and that's funded by the people buying United States bonds in order to get those fundings and pay the United States people, right? So one of the things we look at why that is good for the US economy is that if we borrow, let's say, $1 billion worth of debt as the US government does, in the future, we have to pay back the principal plus interest. But if in the future, the money is cheaper, it's actually good for the US government because we have to pay back less in value in the future. And that's why the Federal Reserve loves to keep an interest rate of around 2% year over year in order to keep paying down debt at a reasonable value. So we talked about the good of inflation for the US economy. Let's talk about some of the downsides of inflation. Inflation's caused things to become more expensive. As you can probably see in housing prices, we see a, let's say, 50% growth over the past year alone in the Austin area real estate, which is insane. It prices a lot of first-time homebuyers out of the market. And it becomes harder and harder for everyday people to have a basic living standard that people had 20 years ago, and that's the same for people who had 40 years ago and 60 years ago. So that's one of the downsides of inflation. Another thing is that if your wages cannot keep up with inflation, for example, if you earn minimum wage at Wendy's or fast foods or retail, making $7.50 an hour, and the inflation has ticked up 2% year over year. Within 3 years, you basically not living up to the living standards. But guess what? That's not the case because inflation has been up and away for the past decade, and the minimum wage has not changed from 750. Federal minimum wage haven't changed from 750 to any livable standards, and that's really bad because you cannot afford basic necessities like cars and housing and food. And that's why a lot of people are struggling in the current state of economy. So that's the downside of inflation. Things become more expensive, price people out of assets and basic necessities like food and housing. So for the past year, the Federal Reserve has been keeping rate at near zero, which means that people can borrow at a cheaper rate. Banks can lend out money at a cheaper rate, so there's a lot more money flowing around in the economy. That's because the COVID pandemic slowed down economic growth, and in order to combat that, we need to have more money in the economy in order to increase spending. So that directly contributed to the inflationary pressure that we've been seeing for the past couple months. So now Jerome Powell, the chairman of the Federal Reserve, believes that the inflation we've been seeing is transitory. It's meaning that it's only temporary, it's not here to stay, and it's not gonna get out of control, causing things to rise 10 times than they normally is. So that if you're a believer in that inflationary pressure is here to stay and we might see hyperinflation or at least out of control inflation in the near future, then you should keep looking at some of the data that we should be looking at, right, that I'm going to talk about next. First one is the CPI, Consumer Price Index. You can find this on investing.com. So now that we talked about what inflation data to look for and where to look for them, we should talk about what instruments we could be trading in order to profit in a inflationary environment. The classic example is the precious metals. Things like gold and silver. They've done really well as a flight to safety investment vehicle. We should be looking at them in the capital market because that's probably the most efficient way for us to gain exposure in that area. We could be looking at GLD, that's the stock ticker symbol, and we could look at buying either the stock GLD or buying the options for GLD. If we were buying options for GLD, we should be looking a couple years out. We might be looking at 2022 January or even July, or might even be looking at 2023. Because if inflation gets out of hand, it's here to stay. It takes a long time for the inflation to go away. And look at Venezuela, right? It's in hyperinflation and there's no way of getting better. Obviously, there are a lot of different factors contributing in the economic environment there. But once inflation's here, it's hard to get rid of. Not like what the Federal Reserve, head of Federal Reserve says and believes in. We might be transitory. Also, you can buy silver. Silver sometimes during inflationary environment shown that it actually can perform a lot better than gold on a percentage basis. So if you're looking for more upside, it can be more volatile to buy some SLV options. But if you have a interest in the futures market, you could look at /GC, which is the gold futures, and it gives you about $170,000 worth of gold in positions when you can only put down about $10,000 worth of initial margin requirement. That means you can use basically less than 10% of the whole value just to gain that exposure. So definitely it's a lot more volatile, but it's definitely a lot more fun to trade those instruments. And if you want a little bit smaller of a futures instrument, you could be looking at /MGC, Michael Gold Future. Same thing for silver, /SIL or /SI. So another investment that could be a good place to place your money is in real estate. In real estate, when people have higher inflation, higher wages, tend to have more affordable, meaning they tend to spend more on housing and therefore have higher appreciation in the real estate value. And worst case scenario, you can rent out your real estate at a higher rent to renters and get cash flow that way. So all in all, real estate can be a really good investment. And I've been seeing the housing prices in the Austin area, in other Texas area, actually growing year over year more than like 20 and 30%, sometimes even hitting 50%. Obviously, it can be unsustainable and cause a potential bubble. But if hyperinflation or uncontrollable inflation is here and is here to stay, then I think real estate can be a really good place to park your money. Now, what are some of the risks to the hyperinflation thesis or uncontrollable inflation thesis? We could be looking at a very proactive Federal Reserve. They might be looking at, okay, inflation has ticked up month over month, year over year, and it has shown that it's not here to go away. It's not transitory. It's here to stay. Then they might act proactively and increase their interest rate in order to combat inflation. Historically, that is done well to fight against inflation. I think in the 1970s, they raised interest rate to around 15 and 20%. It actually fought inflation quite well, although it caused a panic in the capital market as expected. And that is some of the potential risks we should be looking at. In a high interest rate environment, the people have less access to money, and they're less likely to spend money, and they're less likely to borrow money to buy houses, less likely to borrow money to buy cars, less likely to go on getting credit card debt and become a contributor in the consumer economy. And therefore companies have lower earnings, and therefore stock prices tank, and stock prices suffer from that. And along with stock prices, we can see a struggle in the housing market as well. And when the interest rate rise, it becomes more expensive to borrow and pay back your mortgage, and therefore people are less likely to buy houses. And if the supply remains the same, we can see housing prices plummet. So those are some of the potential risks in investing in the inflation thesis. Obviously, we forgot to talk about gold. In a high interest rate environment, no one's going to buy gold. No one's going to buy silver. No one's going to buy precious metal, because they would just rather buy treasury yield. They would rather buy 4% yield, 5% guarantee yield from the United States government than to buy in a commodity that doesn't generate cash flow, doesn't generate dividend. So that's some of the potential risks in this hyperinflation thesis. Where will it go? Let's look at what the market is telling us today. So now, what is the smart money and the big players doing with their money? Do they believe in the hyperinflation thesis? So the market today is actually indicating a different story. They're having a flash. They just had a flash crash in the gold prices. It actually had a crash, drop down to like the 1600 level, 1680 level, which is very, very surprising considering a couple of weeks ago we're looking at $1,800 for gold. And for bond prices, it has remained high and elevated, meaning that the bond yield is still very, very low by historic standard. That means that people are expecting that in the future, Federal Reserve might lower rate. So if they lower rate from 0.5%, you might see 0% rate or even negative rate, even though they've been saying we'll never hit negative rate. But who knows, right? So that indicates that people believe the big money or smart money are betting on that the future of the United States economy in the short term is not looking so good. We will actually experience a deflationary recession, and that could hit us unexpectedly, especially where majority of the investors are buying up houses, buying up stock prices, buying up tech stock, buying SP 500, getting their money into the stock market whatever way they can. They might be borrowing on margin. They might be taking out a home equity line of credit in order to buy into stock options or stocks. So it might pose a very, very big danger in the stock market and in the real estate market. So now, what does a deflationary recession look like, and what are some of the key indicators, and how can we trade in that environment? Please stay tuned for my next video, and we can talk a little bit more about that. If you liked this video, please like and subscribe. And I'm just looking to post more of these educational video and talk about sophisticated investment strategies that could yield a higher return, but potentially taking on higher risks. Thank you.